Hello, everyone, and welcome to the Deed Funding Workshop. My name is Carlton Hoskins. I'm a real estate investor, and I've been investing for quite some time. And there is a new product out, and I'm super excited to share it with you. Primarily wholesalers and investors who are looking to buy properties or leverage existing properties to increase their ROI. This funding opportunity is absolutely for you. So without any further delays, I'm going to go ahead and get started. Today on the agenda, what we're going to talk about is what deed funding is and what it's not, right? How deed funding actually works, who deed funding is for, who it's not for. So before we even get started, you'll get to determine whether or not you want to be here. If you choose to be here, by all means, we're glad to have you. As we continue moving forward, I hope that you will drop your comments in the messaging box so that I can respond to them during the workshop and answer your questions as we go through the process. The idea is not for me just to talk through this process. I want to hear your questions in real time so that I can answer those questions. I'm also going to show you how to submit the funding request. And I'll also give you an opportunity, if you stay to the end, on how you can actually generate passive income by being a funding agent yourself, if that's something you're interested. So stick around. I'll share a lot of information with you during this workshop. Turn off all distractions, devices. Think about this. This is a $5,000 workshop that you would normally pay to go sit down and learn how to utilize new funding. We're bringing it to you live. So by all means, take the time out. This should be about 45 minutes of your time. I want to make sure you get the most out of this information. And at the end, if you have any questions, just let us know. Okay. I'd like everyone to drop in the chat what you do in real estate. Are you a loan broker? Are you an investor? Are you a wholesaler? I just want to get a feel of who I'm talking to. Some of you may be new to Google Meets. So just so you know, the chat button is on the bottom right of your screen. And it looks like a little bitty messaging box, okay? My name is Carlton Hoskins. I'm a deed fund specialist and the founder and owner at MDLQ LLC. I've been in real estate industry for over 25 years. My family grew up in real estate. So I learned a lot of real estate when I was a little boy before I even understood what the mortgage was. My focus and specialty is in tax deeds. I used to travel to Georgia constantly from the state of Texas to attend auctions in DeKalb County and Fulton County. I've been to the auctions in Houston and in Florida. So I've been all over the tax deed market for several years. And when I say several years, I mean plus 20 plus years. I also have background in triple net properties, pre-foreclosures, creative financing, which is my specialty. If you have a situation where you're trying to figure out how to strategize the deal, that is really where my superpower lies. So if I can help you with strategy, by all means, reach out to me. We can have a one-on-one strategy session. I've been a wholesaler, so I know what that market's like, which is why I'm so excited to bring you deed funding, because deed funding actually allows you to stop wholesaling and actually flip your own deals. And of course, I've been involved in quick flips in both Florida, Georgia, and in Texas. Now, in this course, you're going to learn everything about Creative Bridge deed funding. And we're going to do this really quick. We're going to do it in 4 quick lessons for you. But before we move on, I want to make certain everyone understands why this is classified as funding and not a loan. And if anyone has any questions or need more clarity, by all means, again, just drop it in the comments. I'll be happy to answer those questions. So let me just jump right in to make a quick explanation of what deed funding is, what we call Creative Bridge deed funding. Think of deed fundings like a title max. You take your car over to Title Max, you give them the title, they take possession of the title, they give them the funding you need, you drive off in your car. Weeks later, months later, you bring all of the payments back that you owe them, the interest, the principal, etc. They give you back your title, you drive away. If you don't bring back your title, well, lo and behold, they own the title, right? They took possession of the title. They own the title. So if you don't bring back what you owe them, they're going to come and take the car. They don't have to go get a court order. They don't have to subpoena you. They don't have to do anything because they actually own the title. You've essentially pawned the title, if that makes sense. So what's the difference in deed funding and title max? Well, number one, it's not a car. It's a title to a home. So it is the home. And secondly, it's not a loan. Why is it not a loan? Because it's funding. They're not giving you money with a mortgage attached with first position. They're actually taking the title of the property. So they're literally giving you funding in exchange for the title. And I'll explain this a little bit later because they offer you a buyback agreement for the term in which you select. Number two, this is not for the everyday consumer. This is not for a homeowner who can't get a refi cash out because their DTI is upside down or whatever their issues may be. They're still there, right? They are still absolutely living in the property. And because they're living in the property, we don't want to evict someone from their primary residence, right? So in this case, we do not lend deed funds or provide lending to primary residents, number one. So now we understand they're not for consumers. This is not a loan. This is true funding at its best. We'd like to be your funding partners in this particular process. So how does all of this work? Well, it works in two ways. You can work if you're purchasing a property. You can work it if you currently own the property. Now, let's talk those down a little bit. Let's get a little bit deeper into purchasing property. If you're purchasing a property, there's a specific LTV, and we'll talk about that. And it's really not an LTV, so let me clarify. It's an FTV. It's funding to value, not loan to value. As I explained, it's not a loan. So when you're purchasing a property, that's something that you want to acquire. It could be land, it could be commercial, it could be residential. You could be purchasing it for fix and flip. You could be purchasing it for rental, Airbnb, it could be a mobile park. Whatever your reason for purchasing it is perfectly fine. They'll give you a specific funding amount because you're purchasing it. And when you're purchasing, you would need to get the purchase and sale agreement in your hand. So a lot of times there's this question of how do I get proof of funds? Well, proof of funds are required when you're going through a realtor. That means you're probably buying a property that you saw that is on the market. Deed funding works best for off-market properties. That means you're talking directly to the homeowner. You're providing this homeowner with a purchase and sale agreement so that they can sign. When there's an agent in the middle of that, agents are going to want to know the proof of funds. They have so many offers on the table. Deed funding doesn't work for that type of property. So when you're purchasing the property, primarily what you want to do is have the purchase and sale agreement in order for deed funding to work for you. Now, when you're purchasing a property, people ask all the time, well, then how would I do that? I don't have any money. I don't have a proof of funds. And deed funds doesn't provide a proof of funds because you should have a purchase and sale agreement. So when you're purchasing this property, you want to make sure that you're getting it at a rate that makes sense. Why do I say that? Because you want to make sure there's enough wiggle room in that deal. So let's say you're going to flip a property and say the property's worth $100,000. You want to get that property for 50 cents on the dollar from the homeowner, 40 cents on the dollar from the homeowner, okay? Basically, you're saying cover whatever the remaining balance is on their existing mortgage, pay that off, and give them some money to walk away with in cash, right? So let's say you get the property for $40,000, you give them $10,000 in cash because maybe they're in a foreclosure situation, maybe it's a probate situation where the parents have passed, they left the home to the daughter, and now that she has a new tax bill, the property's in Florida. She lives in Connecticut. She has no use for this property. She's just trying to offload the burden. Those are the type of properties that you want to get a hold of. And by getting it for 40 cents on the dollar and then giving them another, $10,000, which is at 50 cents on the dollar, when you're going into the purchase, the deed funds is going to offer up to 60 cents on a dollar because they're giving all of that. That means it covered 100% of the purchase price, right? Including the payout to the homeowner, and leaves an additional $10,000 to fix it, whatever you need to do. Okay, so that's really the strategy that you want to use going into distressed properties when you're purchasing properties using deed funds. Again, if it's a brand new build, you're probably going to have some hard times because they're going to want to see a proof of funds. The builders want to know that you have the funds to buy it. They want to know there's just so many components to it. Deed funds really doesn't work. It's not for everyone and for every situation. So it's primarily for distressed properties. Okay. Property title is in the name of the funder, right? That means when the transaction happened, the property title again gets transferred over to the private investor who is providing the funding in the deed fund scenario. So think of them as title max, right? The private investor is title max. And so when you provide or purchase that property, that title is going to them, not in your name, and you're giving them a mortgage. The title goes to the investor, right? We're going to call that investor TSR for sake of conversation today. So TSR will get the title in their name, and then they will give you a lease option buyback agreement so that you can buy it back within that term. And we'll talk about how you can do all of that in a moment. Okay. So now let's talk about currently owned properties. Currently owned properties essentially stand for what they mean. That means it's property you already own. Who is this for? This is for flippers who have a portfolio, renters who have a portfolio. If you have a portfolio of properties and you're trying to raise funds to buy a new property or to do some upgrades in your property, this absolutely works for you. Currently owned property also includes tax deeds. So if you have a tax deed in the state of Georgia, you're waiting 1 year for this tax deed to mature. And so that if they don't redeem in that time, then you can take possession of their property. Well, realistically, you went to the auction, you paid $50,000 for a property that's worth $200,000, and you're going to wait 1 year in order to take possession of the property. Well, while you're waiting that year, you can come to deed funds, get deed funding, and they'll loan you up to 100% of the amount that you invested, which would be $50,000. And then you could take that $50,000 and go get another tax deed or invest into something different. So there's a million strategies that could be utilized with deed funds. Just remember, if you're purchasing the property, you have a purchase and sale agreement in place, which is ideal for wholesalers because wholesalers are typically getting properties under a PSA, and then they take that PSA and they flip it to an investor. Well, now wholesalers, you do not have to flip it. You can hold that purchase and sale agreement, get the funding from deed funds, update the property yourself, and then resell that property and make 10 times more than you would just wholesaling the paper. And I know the argument, I've been a wholesaler. Well, I could wholesale 10 of those properties really quick. But we know that when we're trying to wholesale properties, it's never really quick because the investors are always going to try to shorten the amount of leverage that we have in that deal. They're going to try to reduce the amount of money we can make in that deal. We'll walk into that deal as a wholesaler saying, we want to generate $10,000 on the deal. But what happens is they'll talk us down to $3,000 or $5,000. Or we have all these deals and now we're just looking for cash buyers to get rid of the paper. Well, all of those who are posting on Facebook, hey, I have all these properties under contract and I'm looking for cash buyers. Well, maybe it makes most sense to get the funding and do the deal yourself. And if you have that many properties under contract, just think about if you can 10x what you thought you were going to generate if you just held on to that purchase and sale agreement, got the deed funds, flipped that property in 40 days, and then walked away with this retail sale of that property. The amount of revenue that you can generate doing that as a wholesaler is insurmountable. It's the next best thing for wholesalers. And I understand because I was a wholesaler. And when I was a wholesaler, the reason I wholesaled wasn't to get an education in wholesaling. I was wholesaling because I didn't have the financial capabilities of acquiring a $300,000 property for cash, right? So now with deed funds, you can absolutely do that. You don't need the cash. Deed funds wants to be your capital partner in that deal. And so, again, we'll talk more about that as we go through this workshop. And if you currently own property, this is the best way to leverage the property. I know there's hard money lenders out there that will do something very similar to what we're doing. The difference is they're going to do a credit check. They're going to ask for a lot of documents. They're going to know what tier of investor you are, meaning how many deals have you flipped. You have to show 3 or 4 or 5 positive deals in the last 2 years to be at a certain tier. And if you don't qualify, they won't fund it or they want personal guarantees. Deed funds wants none of that. We don't check your credit. We don't care about your credit. We don't care about the income. The only thing they're looking at is the collateral, like I was explaining in Title Max. Do you have an asset? What is the asset value? And they're going to base it off the as-is value of the property, not the repair value, not the retail market value after you fix it, but what is the value of the property today? Okay? So again, any questions, just let me know. Be happy to share that. Let's break down and look at how these terms work for each of these deals. Let's talk about currently owned first. So if you already have assets, that includes tax deeds. If you already have assets and you're wanting to leverage that asset to do more investing, which is a highly recommended procedure in all investing, leveraging is the number one rule. You can leverage your assets. Here is how it would work. Currently owned, they would do up to 70% of the as-is value of the property. So, example, property is worth $100,000. They would provide funding up to $70,000. You can take that $70,000, you can go on vacation in Hawaii. You can take that $70,000, you can buy more assets. You can take that $70,000, you can improve some of your assets. You can do whatever you like. Remember, you're giving them the title. They take possession of the title, and they're giving you the funding. So you go and you get up to 70% of that asset. So now, what happens if the as-is value of the property in a tax deed scenario is worth more than what we invested in a tax deed? So now speaking specifically to tax deeds. If I'm in Fulton County, Georgia, and I go up and a property's worth $200,000 and I invested $50,000 at the auction, deed funds will offer me up to $50,000, not more, because remember, the collateral on that is the deed, the tax deed itself, not the overarching deed to the property, but the tax deed itself. And that has a full value of $50,000. Minus or not including what the redemption value would be. Because if it's 20%, right, in Georgia, and you have 50,000 investment, that means there's another $10,000 saying, well, it really has a value of $60,000. Well, they'll actually go to $50,000 to make sure that they're protected. But that $50,000 allows you to go do another deal at $50,000 if you so chose, right? There are monthly payments on this unless you choose to defer them, and we'll talk about deferring. Deferring only happens on monthly payments if the property is currently owned. And I can't state that enough. If the property is being purchased, you cannot defer the monthly payments. If the property is currently owned and you're leveraging your assets, you can absolutely defer the monthly payments. And what does that mean? That means if you did a funding deal with us and the property's worth $100,000 and we provided up to 70% of that amount, so $70,000, and you said, I will pay this back within 6 months, your rate for that funding would be 1% per month, right? So if you said 6 months, that would be 6%. Correct? Minus associated origination fees and things like that. But other than that, you would be paying 6%. You're going to pay 1% per month. Question: what happens, Carl, if we flip this property in 60 days? Well, great. Remember, this is not a loan. So you can buy back within that period, in that term that you select, at any given time, including 24 hours after, right? You can say, I did it, I got it, I flipped it, I sold it. 24 hours later, I want to buy it back. You absolutely can. No penalties, no additional fees associated with it, okay? The faster you flip, the more that we are able to help you, because that means you're doing multiple deals, you're doing volume. The more volume, the more ROI you make, right? So now you're starting to see how this makes sense from a leveraging perspective. So if I'm doing a 6 months deal and I'm paying 1% per month on the example of 70,000, I'm paying $700 a month. But let's say, Carl, I don't want to make monthly payments. I don't want to make monthly payments. I want to just do this. I want to flip this. I'm going to take this funds. I'm going to buy another asset. I'm going to flip that asset. I don't want to take any other money out of pocket to do anything. Well, great. You can absolutely defer the monthly payments. Now, by deferring the monthly payments, you're basically saying the $700 that I'm supposed to pay month 1 through 6, I'm not going to pay until the end when I buy back the deal. So that $700 accumulates month over month. It doesn't stack 700 this month, 770 next month. It does not do that. It's just $700 a month for those 6 months, which totals out to $4,200. That means when you buy the property back for $70,000, you're going to buy it back for $74,200. Does that make sense? Perfect. So that's how you defer the payment, so you don't have to make any additional outlay of capital through the process of holding the funds. And again, this can only happen on currently owned properties and cannot be done for purchases. Okay, awesome. Now, you do have an option to defer the closing. Now, no deferment at all with deed funds can exceed 12 months. So if you pick a term and say, I want to defer 12 months, but I want to get the funding for 18 months, I'll pay the closing 12 months later. It doesn't really work like that. The deferment and the term has to be the same. So if you pick 6 months, we're going to defer closing for 6 months. You pick 12 months, we're going to defer closing for 12 months. You cannot defer anything, whether the monthly payment and or the closing, more than 12 months. Okay. So deferment aligns up with the same terms. So I hope that makes sense. And you can see the rates here. And if you have any questions, just let us know. Okay, let's go on. So now let's look at the deferred monthly payments, right? And this is what I was explaining. And so I don't want to recap it. It does change some of your rates. I was giving you a very high level review of that, but your funding amount will drop on the currently owned property from 70% to 50%. So if you have the property for 100, it's actually going to be 50%. So you're going to get $50,000 if you're deferring. Key is if you're deferring. If you're not deferring the monthly payments, you get 70%. You're deferring monthly payments, you get 50%. Deferring closing doesn't change the funding amount to the as-is value. So if you defer, and you'll find that you can defer in purchases too. If you defer, it doesn't change the FTV, which is the fund to value. But if you're deferring the monthly payments, it does change the FTV to 50%. Okay, awesome. Let's keep it moving. Let's talk about purchases now. This is where the wholesalers get excited. I get phone calls every day from wholesalers. They're super ecstatic about the opportunity to take the deals that they have on paper. They're having a hard time finding these cash buyers. Cash buyers are hard to negotiate with. Everyone's trying to muscle me down on my numbers, blah, 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 blah. Well, flip your own deals. This is the place to do it. You want to flip your own deals. So if you get a purchase under a PSA, you have that agreement. Understand you cannot defer the monthly payments, and there's strategies that we could talk about to help you figure out how to do that if you don't have the funds. We'll talk about that. Okay, this is for the real estate assets only, land, commercial, residential. This does not apply to tax deeds. You can't get funding to go buy tax deeds. Okay, so let's just clear the air right there. So let's keep going. You get 60% FTV if you're purchasing an asset. Assets worth $100,000. They'll fund up to 60% of the $100,000. That doesn't mean it's the purchase price. I'm going to say that again. That doesn't mean it's the purchase price. The property may be worth $100,000, but again, back to my example, you may be able to get that property for 50 cents on a dollar. 40% pays off the existing mortgage. 10% pays the homeowner some money to walk away. That's 50 cents on a dollar. They're funding you 60 cents on a dollar on $100,000. That means they funded well over 100% of your purchase price. Okay, so I know there's a lot of people out there who, we fund 100% of purchase, we fund 100% of ARV. Yeah, they do that. There's opportunities out there for that. If that's something that you want to deploy it. You shouldn't ever limit the amount of financing strategies that you use in being an investor. Use all of them where they are applicable, right? You don't use a hammer every time you stick a nail or a screw in the wall, right? Sometimes you need to use a screwdriver. So in this case, you can get 60%. Again, if you can get it at 50 or lower, which is the best strategy, get it lower than 50 cents on the dollar. You're looking for distressed properties. Again, they're doing a new build. It's probably not going to work for you. If you're trying to buy directly from a realtor, or you're just looking at Zillow and finding the most beautiful house that's for sale and it's something that you want to live in, remember, we don't do primary residence. If it's a beautiful house that you think, oh, I just Airbnb this home, it's a beautiful mansion. Yeah, they're probably asking retail for it. So the as is value is the value, and there's no room in that value for you to make any money. The deal is to make money on the flip, right? Just like you're doing with the paper from a purchasing perspective. You want to make money on the flip, right? You're flipping paper. Now you get to flip the house by using our funds. So now you get the funding. You paid out 50 cents on the dollar, 40% to the bank. That all this happens at closing. You don't have to do any of this, but at closing, it pays off the existing debt. They take possession of the title, which is the funder doing that, and then the 10% goes to the homeowner. They get their $10,000. They move on. They move out. You get the lease option to the property. You're in the property. You could do what you need to do with the property there forward. Now that you're there in the property, there's still that other $10,000. Maybe you only need $10,000 to fix it. Perfect. If you do, then it funded not only 100% of the purchase, but it also funded 100% of the repairs for you. If it falls into that strategy, you can work the strategy wherever you want. I have associates who are looking at 30 cents on a dollar, 40 cents on a dollar, 48 cents on a dollar, and won't touch anything past 49 cents on the dollar. And I know some of you may be listening going, wait a minute, Carl, there's no way. Everyone's paying 110% for property right now. I saw a property go on the market for $300,000, and by the time it closed, it sold for $330,000. That's true. That's retail. That's on market properties. Those are properties that are listed in Zillow for sale, Redfin for sale, all of these places for sale. We're talking about off-market distressed properties that homeowners are trying to get from underneath, whether the property is beaten down and need repair, the property is abandoned because there was a death in the family, it's in a tax foreclosure, it's in a mortgage foreclosure, whatever those situations are. You want to look for distressed properties when you're deploying this particular deed fund strategy for purchases. Okay, so your rates are really pretty much the same. You're looking at 1% per month. 1% per month for 0 to 6 months. And if I'm doing the flip, I'm definitely looking to get out of that property within the next 4 months. I want to be in and out as fast as I possibly can. So typically, flippers are in that 0 to 6 repurchase term, right? So they're getting the least amount of charge on their funding, 1% per month. You flip it in 4 months, you paid 4% on the funding you didn't have. And it covered the entire deal if you strategize the deal properly, right? Perfect. Okay. Again, you can offset the closing if you don't want to come to closing with money because, hey, look, I just don't have the funds. People ask, Carl, how do I get into this for $0? Well, let me tell you how do you get into this for $0. You get into this for $0 if you find a property that you can acquire for less than 50 cents on a dollar and then defer the closing, right? Defer the closing. That's the recommendation. If I can get that property at 40 cents on a dollar, I know I'm going to get 60% funding for the as-is value, not the after-repair value. And let's just say the property is $100,000. They're going to give me $60,000. $40,000 goes to pay off the existing mortgage. $10,000 goes to the homeowner. I still have $10,000 to do a repair on the property. I fix that in the next 60 days, 90 days, 120 days max, 4 months max. And I could flip that, put that back on the market, and now put it on market. I'm not selling it to investors anymore. Now I'm selling it to a home buyer, right? They're going to come in with their proof of funds, their real estate agent. They're going to buy it. And now that property that I acquired for 50 cents on the dollar, that was worth $100,000. I put a little $10,000 into it. Now the property's worth $140,000. And I sell that retail. Well, $140,000 comes back. $60,000 goes to the funder because they're the ones who funded the deal for me, and I walk away with $120,000, $80,000. I walk away with $80,000. You're not making $80,000 as a wholesaler on a deal flipping paper. You're just not doing that. That's not unless you're flipping paper on mansions, right? This is the way to go. This is, I know there's a lot of ideas out there of flipping paper overnight, one time, never touch it, never see it. A dime a dozen people are in there, and those people that are doing it, there's not many people successful like this. What we're talking about is no gimmick, no bamboozle, no magic trick, no abracadabra, none of that nonsense. This is straight up. If you have paper under contract and you know that you can put a little bit of money into it and make the retail value of it, then deed funding is for you. That's what this is about. Okay. And of course, everybody wants to know, well, Carl, what's the fees? What's the gimmick to this? There's no gimmick. There's no hidden fees anywhere. Number one, the only thing that you will have to pay once you've submitted your request for a term sheet, and I'll explain what that looks like and what that process is. Once you've submitted that form, the funders and their underwriting team is going to look at the term sheet that you're requesting. And they're going to say whether or not it makes sense. And if it doesn't, they're simply going to send it back and say, hey, you need to fix this. This isn't right. The as-is value that you stated isn't right. Whatever those numbers are that you're submitting for the deal aren't right. The property address isn't right. Really minimal process to get it done. You can fill out a form in less than a minute. Because we're not asking for your credit card number. We're not asking for your social security number. We're not asking for bank statements or documents or W-2s or your last 4 years of IRS filings. We don't care, right? The only thing they're caring about is the collateral. Provide the property address ID, provide the property address, and provide that as-is value. Don't blow the as-is value up, right? Because they're going to look. They're going to send out an appraiser. They're going to test to make sure that the property value that you stated makes sense. Now, we know there's wiggle room. No one knows what an appraiser is going to come back with, right? But if I look on Zillow and I see a property and it says the property is worth $300,000, that's probably the number I'm going to put in the as-is value right now if they're asking me. I'm not going to look around and do comps and say, yeah, but the market says it's worth $450. Yeah, but those properties have already been repaired. They've already been updated, and they're being sold at retail value. The as-is value is going to be something you could find on Redfin, PropStream, Zillow with a really quick glance of a property. Plug in the property address, 123 ABC Street. What value does it show? The Zestimate, right? We know it's not accurate, but the Zestimate is 275. That's the number you want to plug in because that's going to be a truer number. And if the value is more, the funder is going to let you know that it's more and say, well, hey, we took a look at it. It's worth more than 275. It's actually worth 350. And then you're going to, do you want more funding? Well, yeah, I want more funding. Or no, I don't want more funding. Completely up to you. But we want to be true with the numbers we're submitting. Now, you submit this form. They receive the form. They're going to review it. And if everything's okay, they're going to send you back an official term sheet agreement that you'll sign. You're going to look at it. You're going to make the determination. It's going to state what the funding is, what the payment amounts are, whether you deferred it, if you deferred it, what the repurchase price will be at the end of the term, what it looks like, all the information you need to know. If you agree with it, you sign it. When you sign it, that's when you submit the $40 application fee. Then and only then do you submit the $40 application fee. Okay, so you're not submitting a $40 application fee every time you say I have an idea or I have a property. You're doing it when you get the term sheet. Now, the moment you get that term sheet and you sign it, from that moment forward, it's about 3 weeks to close, right? And we say 3 weeks minimum. We rather under promise and over deliver than over promise and under deliver. So we want to make sure that you're getting, understand it's a 3-week window. If someone says, yeah, but I just need it in 2 weeks, there's no way to push that, right? We're always going to do 3 weeks. So if you're talking to somebody that's in a foreclosure, and man, if we can get this deal done in the next 4 days, Carl, man, this is going to be an awesome deal. Like, yeah, but it's 4 days. We can't do that, right? We need 3 weeks to get there. So now you understand the information, you can create your strategy around that so that you're talking to the right people at the right time. Okay. There's some other things here that happens at closing. All of this happens at closing. Again, if you defer the closing, you don't have to worry about it until the end of it. But these are generally the fees that you'll find on any deal going into funding. There's going to be closing expenses, the recording costs, the transfer taxes, and all that other good stuff. All of this is being paid by you, the person who's requesting the funding. Again, you could defer it, you could not defer it. You can get deeper into the details on what these amounts are once you get your term sheet in, because every deal is absolutely different. Land is different than tax deed is different than commercial is different than residential, or multifamily units. We do all of it. So every deal is different. So you can say, Carl, what's going to be the transfer taxes? I don't know. Depends on the deal. So the funder will be able to provide you that data once you've signed your term sheet. Okay. Now, I want to keep in mind, once you've signed the term sheet, the funder is going to do an appraisal and an assessment of the property. Okay. They're not just going to go off the numbers. They're just not in business to throw money away. No one does that. So if you're like, hey, I have a deal, but I have to do it without an appraisal, it's not going to happen, right? They're going to do an appraisal of the property to make sure the value of the asset is worth what they're funding. I mean, this is just logic. They got to protect their risk on the investment, right? So once they've done a collateral review, meaning they've gone out, they've done the appraisal, they looked at the property, they've done all this stuff. Let's say they come back and say, hey, Carl, this property is not worth $100,000 like you thought it was. This property is actually worth $80,000. Here is what's going to happen. They're going to say, based on the $80,000, and you're purchasing this asset, we'll give you 60% of the $80,000. Now, you may say, I don't want to do that deal. It's not going to work. The numbers aren't going to work for me. This deal is not going to fly. That's just not going to work. You have the ability to just walk away from the deal. But because they paid for the appraisal, they're going to charge you the $500 review fee. Now, let's say you say, well, I got the deal at a really good rate, or the numbers are big enough for me to still work my magic in that deal. I'll take the 60 cents on the dollar for the $80,000 versus the $100,000. Okay, you can proceed, and there's nothing changes. You just keep going through the process. That $500 is still going to be charged at closing, so it's part of the closing cost. Okay, but if you decide to walk away from the deal, they are going to charge you the $500 for saying, I don't want it. So they put the ball back in your court. Now, there are instances where they come back and say, hey, that property's not worth $100,000, it's worth $150,000. What do you want to do? You're going to say, raise my numbers. They're not going to charge you the $500 right there because you raised the numbers. They're going to restructure the term sheet, and then they'll bring you a new term sheet. You sign a new term sheet, which raises the amount of funds you get, and you keep on going down the line, and that $500 is due at closing. Either way, the $500 is due at closing. If you decide not to close because the review of the property is far less than what you anticipated, then they are going to charge you the $500. And let me tell you why that is. Someone has to pay for the appraisal, right? And this is why when we go into the deals, we don't want to inflate the numbers on the value of the property. You don't want to walk in and say the property's, $300,000. I'll give you a true example. Someone went and they looked at a property. The property's worth $550,000. Okay, that's the value of the property. That's the way it shows in PropStream. That's the way it shows in Zillow. That's the way it shows everywhere. Now, that person looked at that property and then looked at the properties around him and started running comps, saying, oh, well, this property is actually worth $1.1 million. I know how to get it to $1.1 million. All I need to do is put a fence up around the property, put a security system on the home, and put a pool in the backyard, and this property is going to be worth $1 million+ and I only have to invest $300,000 to get to that $1 million. That's a really good idea, but they're not going to go off of the after repair value of the property or the future market value. They're going to go off of the current market value of the property as it stands today. So long as we understand that, every time we hear a number, it's what is the as is value? Yeah, but this is what it's going to be worth after. You don't care. The after only applies once you get funding of where you can take it to. But when we're submitting the deals, we have to submit what the as is today. And that avoids any headaches with that $500. Okay. So in the print, it says, if collateral does not meet the collateral profile as stated above, this agreement is canceled and borrower agrees to pay the collateral review fee. Well, it's not necessarily canceled, and they're clarifying that on their agreement. It's not going to be canceled. There's going to be a consideration. There's going to be an offer back to you. Look, it's not worth $100,000. It's actually worth $90,000. We'll give you funding for $90,000. We can't give you funding for $100,000. It's not worth that much. You have the option to either decline, cancel, pay the $500, walk away, or accept it and move on. Okay. There's always a 4% discount to funder, which is paid at closing. That's just static. That does not change. I've had people call me and try to negotiate that down. It's not going to change. They say, well, Carl, it raises my interest rate. Yes. Okay, it does. If you think about it, if you were doing a 6 months deal at 1% a month, that'd be 6%. If you add on the 4% discount, that's actually 10% for that time. And they could look at it that way. Yes, you surely can. However, you receive funding with no credit, no income requirements, no documents, no headaches at 10% for 6 months to flip a deal to make $80,000 on money you didn't have. I'm still going to do that deal. I don't know about you. So if you're serious about moving forward and you understand that, then again, deed funding is for you. So who is deed funds not for? And I kind of went through this, but I want to harp on this just a bit. Cannot use it for a primary resident as collateral. So if you own a home, even if you're an investor and you have 100 other properties, but the home that you're trying to collateralize is your personal home, they will not do the deal on a primary residence. Now, we've had situations where people saying, well, I'm trying to help a homeowner get out of foreclosure. If we can give them the funding, then they can avoid foreclosure and they could give the asset up and we could do this, we could do that. It really, truly, it's their primary resident. It's their primary resident. If they're getting the funding, we cannot do the deal. If you're getting the funding and you're going to take the risk and you're going to take that down that rabbit hole and help them with funding, just know there are a lot of laws around lending to primary residents, which is why we do not lend into primary residents, because there's a lot of stipulations about loaning to primary homeowners. Because once you loan those funds, there are a lot of conditions in order to take possession of that property should they decline to pay you. Okay, so here's the rule of thumb. Stay away from primary residence. But if you choose to go down that rabbit hole, just understand we cannot fund the primary residence. So if you're requesting the funding and it's your property, we cannot fund it. We will not fund the homeowner. So I hope that's really clear. You're taking it and then funding someone else. That's your business. That's up to you to strategize that way. Just be very careful in that world. Okay, who is it right for? As I explained, this is for the wholesalers. These are for investors. And of course, mortgage brokers, this becomes an alternative in your tool belt when someone is trying to get funding for an investment that for some reason you can't find them the funding for it. Deed funds could be the way that you could utilize this to help them out, right? And some mortgage brokers have decided, look, we'll just be agents for you alongside what we're currently doing, because I do residential over here and I do investments over here, and I have a need for it. So we have a lot of mortgage brokers that work with us for this type of funding, including realtors. They come up with different strategies because realtors are investors too. So they'll come and say, oh, wow, I could use that funding to get this deal. I could grab this deal really quick. I can get some other people. I have the contractors. We can fix it. I could flip it and sell it back wholesale. I mean, retail. Perfect. Absolutely. So it's for investors, whether you're doing Airbnbs, multi-unit complexes, hotels, mobile parks, whatever, storage units, whatever that is. Remember, land, commercial, residential, all of it applies, including multifamily properties. So all of it applies for investors, mortgage brokers, etc. Wholesalers, I really just think this is a super add-on to you. This is a brand new belt for you, because right now you are flipping paper because you don't have the financial wherewithal. I don't know many investors who have $1 million putting into assets who are flipping paper. Now, I'm saying they don't. It's not that they don't flip paper. They do. They'll get a deal and they're like, you know what? I just don't even want to deal with it. I don't even want to worry about it. So they'll take it and flip the paper out to another investor who might be interested in it, because, you know, I only do 3 bedrooms, 2 bath, built after 1980 properties. I got this deal under contract that's 1968. It's got 2 bedrooms, 1 bathroom. That's really not my market. I don't want to deal with it. I'll flip it to another investor that I know, which is where wholesaling came from, right? Just wholesale the properties off. Someone else will pick it up. Wholesalers have built their niche in that world of, this is what I'm going to do. I'm going to get properties under contract. You are the hardest working in the real estate industry because you're door knocking. You're talking to homeowners every single day, and you're getting papers on the contract every single day. You are the inventory to the real estate market. You are a superpower in real estate. The only thing that you're missing is the funding to do your own deals. If investors can go out and do what you do and get those deals, they would never buy flip paper because they would just get the paper themselves. This is why investors like going to wholesalers and bird doggers to go get deals, because you guys are doing the work. So I'm telling you, if you're a wholesaler, this makes all the sense in the world. All you have to do is get the deal under contract and then bring it for funding. You get the funding, and instead of making $8,000 on the deal, you might make $20,000, $30,000, $40,000 on the deal, right? Now you get to build your own capital base so that you can be your investor with your own pocket. This is the idea for wholesalers. So again, I think this is an amazing program for wholesalers. So if you're a wholesaler, you're watching this, share this with other wholesalers. You're an investor, you're a mortgage broker, share it with the world. And again, you can all become agents if you wanted to. You want to affiliate with us. We want to work with you. We want to get this funding out so that we can help you acquire more properties and do more deals. Okay. Really quick, I'm going to fly through the application process just to say that I've gone through it and so that you have an awareness of how it works. It's a really simple 5-step process. You're going to complete an application. It's a simple 1-page form. It doesn't ask a lot of information. Typically, it's going to ask you, what's the property address, who's asking for the funding, you know, the contact information for that particular individual, what's the property address, what's the as-is value for the property, how much are you looking for, and what terms do you want? You get to pick your term, right? Once you've done that, you submit it, right? Remember, get the as-is value from something that we can go verify, right? Don't come back and say, well, Carl's going to build a pool and build another level to the home, so it's really worth this much money, because that doesn't count. That's not the numbers we're looking at, right? Don't tire kick. Don't just submit every piece of property that you get. Make sure it makes sense for you, that if you get the funding, you have an exit strategy that's going to provide you with some revenue and not take you into a loss, right? So the funder reviews the application. They're going to send back a term sheet to you. You can decline it. You can say, I don't like it. It doesn't work for me. I don't want it. Don't sign it. Perfect. If you like it, you sign it, you submit the $40 application fee. If you're deferring closing, well, guess what? You've only paid $40 to get to the closing table and get asset on the property. Funder's going to begin the due diligence on the property, as we talked about, and then you're going to pick the title company that makes the most sense for you. Where are you? Where is the property? Typically, it is, where is the property? Now, I'm in Texas, and I do deals in Florida and Georgia. I am not picking a title company in Florida because I am not in Florida. Now, if I need the homeowner present because of some necessity, then I may say, okay, put it in Florida and I'll sign mine by virtual signature. Okay. I don't have to be present in the state to sign. Some people like to fly out. I've met a lot of people in first class flying on American Airlines. We sit there and we talk. I'm like, where are you going? Oh, I'm going to Dallas. For what? Oh, I got to go sign this deal. Like, why are you flying in? Oh, I just want to be present. I just want to see. You could spend that $1,000 to go out there and see if you want to, or you don't have to. Okay. Whatever title company you want to use, that's the one you pick. That's where the funder will close the deal. Perfect. Okay. Any questions for me? Okay. So I have a question. Who pays the taxes and insurance on the purchase? That's a great question. If you're purchasing, who's going to pay the taxes and insurance on the purchase? Well, because the title is going into the funder's name, the funder is going to pay the taxes and insurance to make sure that the property is paid their tax liabilities and that the property is insured. When you buy the property back at the term ending period, or whenever you decide to buy it back, that is when they are going to attach what they paid on taxes insurance to the repurchase amount. Okay. So whatever that amount that they paid up front, that's the amount that you're going to be added to the repurchase amount. That's a great question. Okay. So I don't see any other questions right now. It makes me think everyone's got it under control, understood. If you have any questions, please feel free to drop us a line. You have the contact information for me here. I'm always on my phone at 940-735-5623. Call me. You'll get my direct line. I'll be happy to share that, answer any questions you have. We could set up some strategy calls. We can have conversation there. Reach out to me at my email. We do have a website that's coming up. You can actually go to deedfunds.com. You'll find more information there as well. That website is up. I just haven't updated this page, so forgive me for that. So again, you can go to deedfunds.com. You can schedule time to talk with me if you have some one-on-one strategy sessions. Some people get on the phone and say, Carl, how do I really create the strategy? What strategy should I use? Here's what I'm doing. And I'm happy to share that strategy session with you. And we could talk more about that. Now, real quickly, I'm just going to go into, if you are interested in becoming a deed funding agent or an affiliate, I'm going to say just reach out to me. We have some new processes coming in place. You have the capability of generating percentages of every deal that comes through the door that you submit. This is a quick way to make passive income while you're already doing your deal. So think about it. If you're an agent and you bring in another agent, you'll get commissions off of that agent's work. If you're doing deals, you might recommend another wholesaler to the fold. Wholesaler comes in and brings a deal, you get a commission on that deal. There's so much information. We're going to have upcoming events that are going to speak specifically to that topic, deed funding. So it is a way to make passive income. Again, if you're interested, reach out to me, drop me an email, go to Carlton@deedfunds.com. You can also reach me at 940-735-5623. Get on my phone and let's talk. And I thank you all for joining me today for the workshop on deed funds. I hope the information has been super helpful. I'm so glad to be here. I'm super excited what it's going to do for you all and how it's going to change the game and give wholesalers an opportunity to make more money, add more tool belt access to brokers and real estate agents, and also provide an opportunity for real estate investors to leverage what they have when they don't want to go through docs and W-2s and credit and all that other nonsense. Deed funding is the way. Again, my name is Carlton Hoskins. It's been a pleasure to meet with you, and I look forward to talking to you soon. Have an amazing day.